So today we're going to learn market cycles and stock cycle. It's super important that you understand in which phase we are every time that you want to put on a trade. So let's get into it. Okay, so every stock you trade moves through the same 4 stages. Once you can spot them, you know exactly when to buy, when to hold, and when to get out of it, the hell out of it. So the stage 1 is the base. And this applies to market, to stocks, to anything. Okay, the base is literally when a stock has been beaten down. So like here we come from a previous downtrend. There is no trend. We are choppy. It's boring. We are moving through the averages. There is no clear direction like in this area over here. So here the smart money are quietly accumulating and the retail traders don't really care and they're ignoring the stock or whatever it is, ETFs or the market itself in that moment. Then we have the stage 2. So from a flat and choppy environment, we have a break to the upside. So the stage 2 is where real money are made. So the price start moving above the moving averages. The moving averages are starting to slope higher and you get a higher highs and higher lows. Pretty simple. This is the stage where you should be actually buying in and everything else is either too early or too late. So again, here what you see, this move higher is all at stage 2. So we broke out of this choppy environment. We are above the moving averages. The moving average is sloping higher. And here is the moment where we buy. So all of this going up, it's a buy for us. Okay, that's where we make our money. It's a simple and visible uptrend. Sometimes though, some people are not really realizing that we are in an uptrend. They're too scared to put on trades because they're scared that, maybe there was a previous downtrend or people had a drawdown. So they're scared to put money on the line. But these are the moments when you have a break out of a choppy market. These are the moments where you should buy. Now, the stage 3 is instead the topping or distribution. So after a strong move higher, the stage 3 looks like similar to a stage 1. Why? Because we start moving sideways and being choppy like a stage 1. Look at here, we had a big push to the upside and then we started moving sideways. We are inside this range over here. So we're not going higher, we're not going lower. But this is happening in a different place. This is happening after a big rally instead of a big decline. So this is a distribution. Smart money are selling into strength while latecomers are still buying the dip. That's your warning sign to trim your position or to exit your positions. And you will see it that many times you have down days with higher volume than up days. But it can be really confusing sometimes and it really helps if we look at what happened before. So if we're coming out of a strong uptrend and we start moving sideways, the probability that a distribution is going on is higher. And then we have stage 4, the downtrend, the decline. This is when it breaks down. In this example, this literally broke down and the price start moving below the moving averages. We have lower highs and lower lows. This is where most retail traders are still hoping for a comeback. Don't be that person. So it's really important that next time that you look at a chart, you don't look at just, today candle is good, or I like this pattern. No, you need to understand in which cycle, in which stage of the cycle you are. So you need to look at the broad market and see first which stage of the cycle we are, and then you look at individual stocks. And that's the way you should look at things all the time before putting on a trade.